Hello, everyone. Welcome back to another episode of Test, Optimize, and Scale. I have a regulated investment crowdfunding legal expert here on the podcast today, Brian Korn, head of FinTech and Blockchain at Manatt, Phelps Phillips, one of the top, if not top law firms in the space, also a board member of the Crowdfunding Professional Association since the early days, a pioneer of this vertical of investment crowdfunding at that. Author, going to be speaking about experience with issuers. Brian, thanks for taking the time to join the podcast here and create content with us.
Thank you, Jason. Great to be here.
And I'd heard so many great things about you from different CFPA, Crowdfunding Professional Association board members. Some of the folks who created the Jobs Act told me stories about you. I've been looking forward to this discussion, but where did it all begin for you? Where did your career path start, and how did you get involved in this world of capital raising?
Yeah, no, interesting start, and not, I didn't come out of law school thinking I was going to do crowdfunding or advise on capital raising issues. Graduated in 1997 from law school, started at Sidley Austin law firm in Los Angeles, moved to New York in 99 for working for Weil, Gotshal and Manges. Earlier in my career, I had a lot of experience in M&A transactions and securities offerings. I did a lot of work for Starwood Hotels, which you might remember was bought by Marriott, but before that, they bought ITT Sheridan and Westin. So I worked on both of those transactions, which also included the purchase of the New York Knicks and New York Rangers. So a lot of interesting sports issues that came up in those deals. And then at Weil in New York doing capital markets transactions, worked on the Enron bankruptcy, which many of you might remember, or you can look it up. One of the biggest fraud and complex trading disasters of recent memory. Company had built basically an energy trading platform that was going to be sort of the Wall Street of power credits. And it had not worked out the way it thought, and then it leveraged everything and had an extreme amount of energy assets. So I was in Houston for almost a year on Enron, and moved over to Paul Weiss law firm. Worked there for a while. Worked with Ted Wells, who wrote the Deflategate story on Tom Brady, and a number of other interesting clients there, and wanted to go in-house. Worked at Citigroup Global Markets, was associate general counsel at Citi, doing investment banking transactions. I was the legal side of the IBD project in various industries, healthcare, energy, financial services. Moved over to, and while I was at Citi, actually, we had the recession in 2008. The company's stock went from $55. It traded in a $10 range for, all that anyone could remember. And it actually dropped below $1 while I was there. And we all looked at each other and said, what happens next? Worked on Citi's attempted purchase of Wachovia, which was a big bank in the Southeast. And actually, during that time, Wachovia was snatched up by Wells Fargo. So kind of an interesting aspect, both on the Starwood side with ITT and then Wachovia and Citi, seeing a lot of high-stakes M&A. I worked on the Visa IPO. I worked on Facebook IPO, a number of large tech transactions, going private transactions, tracking stocks, SPACs. Early days of SPACs, little huge SPAC, $1 billion SPAC for Lazard we did. Moved over to Barclays in 2010, and I was head of compliance for equity capital markets and their equity syndicate desk, which is the desk that actually does the distribution of new issues. So they find buy-side investors and place order books and get deals placed with the buy side. So a good merging of those two worlds. Like the compliance side quite a bit, but wanted to go back to private practice and had an opportunity to do so first at Pepper Hamilton and then in 2015 at Manatt. I've been at Manatt since 2015. The Jobs Act coincided with my time at Barclays. Jumpstart Our Business Startups Act 2012. It was really one of the watershed pieces of legislation in the securities world during my career. Some of the others were Private Securities Litigation Act of 1995, which was admittedly while I was in law school, but I was a summer associate at the time and had to write something about it. And then Sarbanes-Oxley in 2002, which was a response to Enron and others, WorldCom, another case like that came out. Corporate governance, the certifications you see on public reports now with respect to the CEO and CFO certifications, a lot of the accounting issues, the PCAOB, all of those were born out of Sarbanes-Oxley 2002. And then the Jobs Act, sort of the next big piece besides Dodd-Frank in 2010, which was a result of the financial crisis. So there's a trend here. Jobs Act was a way of democratizing capital raising. It had four main aspects to it. Number one, make IPOs easier, reduce financial burdens, financial statement burdens for new issuers, reduce the increase the amount of time you had to file reports and allow you to test the waters before you file for an IPO. Number two, Title II, big change here, the ability to publicize private placements. So until now, we had a world of public offerings where you filed a public offering and then you could talk about the deal and sell the transaction. Private placements, which were hush-hush, you had word-of-mouth marketing. You weren't allowed to solicit until Title II of the Jobs Act. Title III, which is public crowdfunding, which became Reg CF. We could talk more about that. And then Title IV, which is Reg A+, which was the ability to use Regulation A, which has two big advantages to some of the other bills. Number one, you can freely trade Reg A securities right away because it's, on the technical side, a Section 3 exempt security, not an exempt offering under Title IV of the Securities Act. But the other thing there is that Reg A is open to non-accredited investors. And so for a lot of the world, including the crypto world, where the world is largely non-accredited and not in the world where they want to have holding periods like you have under Regulation D with private placements, in the Reg A, you can sell to non-accredited investors. And you do not have to impose a holding period. And so those four big acts really changed the game with respect to capital raising. And crowdfunding, Title III, had a lot of changes as it wove its way through the legislative process. And as it got through the final step of the legislation in the Senate, a number of requirements were added to Title III that I thought were designed to kind of make it less attractive. And really, the concern is that Title III and crowdfunding was a province for people to come who are fraudsters, who are going to rip people off. They didn't really have a prospect of raising capital because they weren't, they were obviously not making it work in the venture capital market, which is the way in the 90s and early 2000s, the way that most companies raise capital is they would go to angel partners, then venture partners, then late stage venture. Finally, they'd IPO after their Series D re. And crowdfunding was a way of getting smaller investors in the door at lower valuation or earlier stages, leveling the playing field, allowing people to buy in early stage. And so Congress was very worried that this is going to be a vehicle for people who are not seasoned to get hurt because crowdfunding companies have less of an operating history. Their management hasn't been vetted by Wall Street and by research and by all of the things that we take for granted with respect to public companies, accounting firms, auditors, law firms that are gatekeepers. And so they added on a number of requirements, a holding period requirement, a time period where disclosure would have to be filed prior to the offering starting, which is 20 days. Restrictions on how much you can invest across all crowdfunding, which is the only law that I'm aware of where you actually have to count what you put in deal A, and that actually could affect your ability to invest in deal B. We don't have that in other investment vehicles and other rules, and enhanced liability for both the company and funding portals who are taking these companies out in crowdfunding deals. And so I wrote a number of articles that were sort of negative on crowdfunding because I thought, well, who in their right mind would do this unless there was no other way to get money, because it was going to cost more. You're taking more liability. The burdens are higher. The burdens on the company and on the funding portal to check investor qualifications, that they're not spending too much. And they added strict liability for crowdfunding, which means that your misstatements have basically IPO prospectus accuracy requirements, as opposed to the fallback for private, non-registered private deals, which is what we call the 10b-5 standard, which means you have to have intent to defraud. And so in crowdfunding, you don't need to have intent to defraud. It just has to be a material misstatement or an omission required to make a statement not misleading, and that is enough for liability purposes. So I was very negative on this space, and the negativity, I guess, got a lot of attention. I went on talk shows. I was on NPR. I was on Fox Business, who were also negative on crowdfunding. Surprise, surprise. And I found myself in a conversation with people at the SEC who were then tasked after the Jobs Act with implementing the rules. And the rule implementation was not exactly the same as the statute. And so there was an opportunity to be heard on what my objections were for where I thought this could go wrong. And I joined the Crowdfunding Professional Association and joined the board because I thought that it was a great opportunity to help people who did want to raise capital, to create an integrity-based forum where people would, who do want to raise money, who are not looking to rip people off, to do so in a way that was going to be responsible and compliant, but at the same time, it should not cost you, half of your offering or a quarter of your offering to pay the expenses of your deal. And so that's kind of how I've gotten into it. Reg A as well. I saw a lot of opportunity with Reg A. I do a lot of Reg A transactions, both on the equity and on the debt side. I represent a couple of Reg A issuers who have ongoing offerings of debt securities in the real estate and art world and other areas, and they are using Reg A as a way of doing continuous offering to non-accredited investors, and not being a public company, but still being able to access the public markets and to access non-accredited investors and give them a product that's freely tradable.
Fractional, ongoing debt and equity type deals.
Correct. So you have, within Reg A, you have the ability to do a continuous transaction, provided that you start within 48 hours of qualification. 48 hours is defined as real hours, not business hours. So you got to launch the site on Sunday. That's the way it's got to be.
Yep.
And you'll have offerings either, in one case, we've done equity REITs, where you'll be able to continuously buy shares in a transaction. There'll be a monthly closing, so there'll be at least a demarcation of what your value was at the time you purchase, or quarterly close, and then you track your value based on your original investment value. On the debt side, where you could actually invest in specific transactions, specific loan transactions, and your return is based on the repayment by the underlying borrower.
Well, first of all, Brian, thank you for going into the details of your background. I felt like I was going through time travels with you from 97 in LA to 99 in New York, hearing about your success in M&A, Starwood, where I in school worked in the travel vertical. I remember these brands. I know some of the details of some of the groups you were mentioning there, and to hear what you're involved with Knicks, other sports teams, as well as at Barclays, and even hearing you talk about Reg CF, Title III of the Jobs Act, and putting it the same level of these acts in 2002 and 95 and all these different periods, 2010. It's nothing short of amazing. You were there. You were part of these discussions all the way through. Yeah. The background on Enron there, every detail. I can only imagine what those conversations in Houston sounded like participating. But to hear about you speak about Reg CF in this nature, now watching it evolve a bit, from the pre-2016 days and what's this going to look like? Hey, you're part of the Crowdfunding Professional Association to May of 2016. These deals start going live. Some of them are now maturing into Regulation A plus deals. We've worked with groups that have 2, 3, 6 Reg CF filings before going into the world of Regulation A plus. And I recall the stigma 2016, really to 2020 of, hey, this deal probably couldn't get funded offline. That's the only reason they're using these vehicles. They're trying to find whoever they can now. To speaking with much more mature CEOs, CEOs of much more mature companies that are saying, hey, valuation we're able to command here versus having to wheel and deal in negotiations with investors offline. The way we're able to bring thousands of investors in. We've worked on Regulation A plus campaigns that have over 51,000 investors at this point and could use every one of those individuals as ambassadors, as marketers of their brand with every new update. And being able to have, I don't want to say more control in a way that sounds opportunistic as much as more control in the sense they're not losing control to VCs, and they hear some of these horror stories from traditional fundraising methods. Well, what's your perspective on how everything has really grown and been built since 2016 to here in 2025 with the actual deals?
So 2016 was an interesting time. First of all, the law was passed in 2012. So right. There was a long time where we had no rules. And everyone was sort of, what's going on? What's taking so long? It wasn't sure it was a priority of the SEC. We had a fairly protective commission back then. I believe the chair was Mary Shapiro, then Mary Jo White, then Jay Clayton. And it was almost as if, okay, well, the sooner we put these out, people are going to start getting ripped off and we're going to be blamed. And so there was a little bit of a slow crawl to get the rules out. And also people wanted something that was going to be comprehensive and not subject to interpretation. The staff didn't want to put out something that was going to have a lot of no action letters or, the equivalent of that, which are the informal, used to be called the telephone interps. Now they're called compliance disclosure, where you have frequently asked, basically an FAQ that the staff puts out. So in 2016, there weren't a lot of players that had stepped up and said, I want to be a funding portal. And an investment bank could be a funding portal, but very few of them really want to do that either. And so
all deals.
Couldn't do funding. You couldn't do any crowdfunding until a funding portal was registered and licensed by FINRA, and then agreed to go into business. And so the part of the problem, which was fixed later, was that the offering ceiling was $1 million for Reg CF, and that really kind of cut a wedge into, a lot of companies want to raise $3-4 million as an initial round. $1 million sounds like a lot, but it's when you're dealing with a business, it doesn't get you a lot of runway. And if you're developing something that's not ready for market, you're going to have to rely on that money for a little bit of time, maybe a year, 2 years or three. It's $5 million is a lot easier to swallow than $1 million. And so that kind of limited things. The other thing was that people had this ethos that crowdfunding was there for charitable reasons, and that they had this rewards-based crowdfunding community. So the biggest crowdfunding companies were those that were Indiegogo and Kickstarter, who were in the rewards space. They're putting money in to help people build their product or their prototype, and your reward is a T-shirt or a hat or a coupon to buy something, or maybe something down the road, but you weren't getting equity. And there was almost a negative connotation of people who are trying to raise money through crowdfunding versus reward space. And you have the donation space and GoFundMe, of course, everybody knows. And so it was almost like, well, if you had a bad thing happen to you, crowdfunding is a great idea because your community can come together and put money in, and either individually, like people who lost their homes in fires, you see that, or flood relief, or if you're trying to do something cool and people are supposed to put money in to support you doing that. So investment crowdfunding had a little bit of a slow start there, and there's the famous case of Oculus, which did a rewards campaign. People bought, they spent a couple $1,000s on Oculus to help them build their prototype, and then they raised $2 million, and then Facebook bought it for $200 million, and everyone thought, where's my payoff from the Facebook exit? And a lot of them weren't aware until then that their investment was a rewards crowdfunding purchase, not a investment crowdfunding. And so so I think that was part of it. I think that the early stages, you had to be a pioneer. Start Engine, WeFunder, those were just getting started. There was our crowd, which is mostly for accredited investors. And so the Reg CF world hadn't really taken shape. And the numbers, if you look at the early Reg CF, were pretty low. There wasn't a lot of action. Deals would get posted and then sit there and not move. And I think that a lot of people assume that I sign up for my deal, I get it posted on the site, it's going to sell in a day, an hour, 3 days, and it'll be done. And what a lot of people didn't realize is that funding portals are not investment banks. They're not working the phones for you, right? In fact, they can't work the phones. They're there to, be a vetting tool, to be a regulated hurdle for people to have to jump through, so that it's more difficult for somebody to completely defraud the market. But they're not there to sell the transaction. And so as people started to realize that I needed to have my own momentum, do my own marketing, get my own industry, cohorts involved, and get others interested in my product and in my offering, that drove a lot more people into the space, and people got more comfortable after they started to invest in 1 or 2 deals and they started to see the returns. There was also reduced caps on investing if you're an accredited investor, and I think that opened up the world a little bit more, because as good as you were at finding people, if you only found non-accredited investors, the amounts that they could invest was pretty low. And because remember, the threshold was the lower of your income, 10% of your income or net worth, not the higher. And if you were a non-accredited investor, the most income you could have is just under $200K. So you're talking about $20K, and a lot of people were in lower categories than that. If you made $100,000, your cap was $10,000, and so on. So you need to keep finding new investors, and it's hard to do that.
It absolutely is. And I think there are a lot of misconceptions reflecting what you're saying there of, hey, take a deal live. It's going to be online. Look at all these companies that have raised 5 million. Look at these companies that have raised 75 million at this point using Regulation A+. I dive into the analytic platforms. I try to tell founders, CEOs who are going down this path, it's really the top 10% of issuers who are moving, the bottom 50%, kind of stagnant when I look at the averages for 2024, for 2023, even for what's trending for 2025, about 130, last year about 114K, half the issuers get stuck underneath that. And it really is a formula that these other issuers are using where they're bringing in their first degree network, second degree network, minimum investment, $100, 500, maybe 1,000. So if they're getting 1,000 investors at an average of $1,500 on a Reg CF, that was the average investment across 1,408 Reg CFs last year. This year, I think it's going to be closer to 2,200. I think Reg A will be more like 2,700. Last year is around 2,300. But as a marketer, I really point to these examples of, hey, you can bring 50,000 visitors to an offering page. If you're getting a decent conversion rate, maybe 2%, if you're getting 1,000 investments off that, if it's 1.5 million, maybe 3 million, $1,500, $3,000 average investment, and you're thinking about it in these terms of, hey, this is a marketing exercise, and I'm going to get a lot of awareness, I'm going to get a lot of people to the deal, even if only a small percentage of them convert. If it's at a high enough average level and a high enough conversion rate, there's going to be a substantially large amount, in relatively speaking, towards my goal. And then I could scale as I feel more comfortable. And I'm marketing, I'm seeing success, I'm getting a good return, like you said, not spending too much on the raise itself. And I found these founders, these marketing teams that are able to do this successfully, once they're able to crack the code. I don't want to say it's systematic in terms of how they scale, but there's definitely some consistency to it. And they take it to their next round, these larger stages, these larger Regulation A+ campaigns. And it does democratize access to capital. They are able to advertise and be showcased, featured in different events, and have ongoing content announcements to everyone who's following them. And they are very powerful tools and effective at reaching a high volume of investors. And again, if the conversion rate's there, seeing the capital come in to follow.
I think that it's almost like anything. If you do something well, and you prove yourself to people, they will be repeat customers. Just like if you have a restaurant that consistently churns out a good product. The mistake is to go in and assume that money's just going to drop from the sky, or that all I need is one retweet from a celebrity and I'm going to sell like I'm on Spotify, right? This is an investment business. It's not instant gratification for the investors, so it's a little hard to see that. If you look at the crypto market, which if you're talking about the top investments there, they're very liquid. The thing trades 24 hours. You could be in and out in less than a day. The stock market, even which has reached fairly high valuations recently, record valuation last week. You're also seeing something, the stock market, public stock market is a liquid market. So you're competing for dollars in a world where your investors are going to have to be patient and they may not see a return for a couple of years. And that takes a little bit of attitude adjustment when you're talking about some people who are new to investing or new to crowdfunding. The expectation value and kind of the thrill value is tempered a little bit because you're not going to see the dollars right away. Now, hopefully that's counterbalanced by the excitement of helping entrepreneurs realize their goals, and also that your money means more to them than the public company. Most of that's secondary trading anyway. So nobody is appreciative of your investment like a crowdfunding company or capital raising campaign. So I think that that's something else that to think about. Now, it is subject to kind of macroeconomic considerations to the extent that the target audience is one. If your product is, I had a client that did a lot of lending work to the military. If the military is downsizing or they're not getting paid, during a shutdown, or there's concerns about the future, you may be in a situation where your target market is depressed or has less disposable income, where they can devote and put into an illiquid investment. And so a lot of that is kind of reading the room and timing, and trying to put out something that's compelling enough to people where it will have resonance. I think the TV show Shark Tank actually did a lot for crowdfunding because it kind of exposed the market. A lot of people didn't realize that they have these pitches where people go in and they talk to VC investors or regular investors and say, "Here's our idea," and just the lingo on that show about valuation, sales, revenue, percentage ownership, percentage equity, all of that is really helpful in educating the public. And when they go to a crowdfunding site, they could say, okay, well, the campaign is for 20% equity. Here's the valuation target. Here's, a realistic forecast of when I'm going to get my money. And it's, I think the big goal is turning the casual investor and the one who's not really there 100%, like they want to be in the site because they're helping their friend or they're supporting a campaign that they have some connection to. But, really turning those people into real investors and people who are going to look for other campaigns and support those. And, we have a venture fund at Manatt, and I think 6 out of 10 investments we have are complete failures. And the idea that there'll be, 3 companies that do moderately well, then 1 company that hits it out of the park, and that gives you a huge return off of your money. You can't just do one campaign and say, all right, well, this company, let's hope it does well. You have to be in multiple deals in order to properly play the market. Like going to a craps table and only betting on the pass line, and then waiting for 10 minutes to see if the dice come back to the same number. There's a lot of other bets you can do to spread your money around so that you're hedging yourself and giving yourself an opportunity to be successful in more than one way.
High risk, high return section of the portfolio, diversification, having the right mentors, guides to, really educate through this process. People like you, I know the portals, I know there's many thought leaders in the space talking about how to set up the portfolio around this. With my research, data collection, I've found, investors with well over 100 of these deals in their portfolio. In fact, I think the conference we were at in DC together, the Crowdfunding Professional Association summit there's a gentleman who had invested in a deal every day in 2024, so over 300.
Is that right?
Paul Lovejoy. Yeah, he proudly speaks about it. So it's just something I'm pointing towards.
But also the big thing there is what percentage of his income and his assets are in crowdfunding, and that's the other thing here, right? So if I have percentage of my income is in market, or it's in 401ks, or in other things I have to invest in from Manatt. Am I allocating enough to crowdfunding for me to take it seriously and for it to be the right percentage? I've seen informal studies that people recommend they put at least 5 to 10% of their disposable income into these investments as a way of possibly capitalizing on high growth opportunities. Nobody's saying pay your rent, put your rent money into a crowdfunding campaign, but you got to be in it to win it. And there's a joke that I heard that this person died, had a hard life, went to heaven and said, God, how come you never helped me? And he said, every single day I sent the 50-50 guy up the aisle of the game you're going to, and I sent you bingo tickets, and I flashed lottery ads in front of your face, and not once did you buy a ticket. And so, kind of an interesting thing there, right? You have to be in it to take part in order to reap the returns. Now, so I think it's being smart about that, allocating yourself enough and in enough different campaigns where you do give yourself a chance to capitalize on. So
I think you have a much better chance than the 50-50 at Dodger Stadium, at least. I play every time. I don't know anyone who's ever won. But we're all playing for those Oculus type situations. That was actually the story that brought my attention to the world of Reg CF in 2014, was already working on marketing plans for Reg D, and with my background in ad tech, using audience data to target accredited investors, high net worth, household income, filtered by their behavior online. Also, many people talk about the Facebook IPO. I now know you worked on that one alongside Visa as well. And the storyline of what if you invested in the first year, the first few rounds, first few years of Facebook, what would that have meant once they actually went public? So I definitely think that's what we're shooting for as investors in this space, as professionals in this vertical. We need more investor success stories. King's Crowd has a great platform. I'm very big on numbers and research. King's Crowd is an analytics platform, and they have a tab for IPOs, exits, failures. Only about 10% of the companies who have used Reg CF to date have actually gone under. So you look at 7,000 companies. That's much different than the startup world, at least what I see here in Los Angeles in the studies that I've read. And then the IPOs, the companies that have exited, have sold. There's a decent amount. Not all of them do great when they IPO and hit the market, but I do believe as there are more of those investor testimonials of, hey, I came in at this level, $20 million valuation when they're a Reg CF company. Now they're $3.5 billion. They're using Regulation A plus. When they went public, they went at this level. I do believe that is going to spotlight. It's going to get more mainstream attention from the business, the entrepreneurs, the mainstream world as a whole, and media channels, media platforms. Not just about concerns around Reg CF, Regulation A plus, but people who are benefiting from it and growing with organizations. So I definitely
one thing that happened. When crowdfunding first came out, there was this assumption that the crowdfunding issuers were only there because they couldn't raise from the venture world, and then conversely, that if you did a Reg CF deal, you would be less attractive or untouchable by a venture investor because why would Sequoia or Greylock or Coastal Adventures, or you name it, why would they put money in at a worse valuation than the Joe or Jane Schmo did 6 months ago? And so that concern, I think, has largely dissipated. And I think part of it is that the companies that have the discipline to actually run a credible campaign, which means that they've been able to produce a coherent disclosure document that's passed the scrutiny of a funding portal, and they've been able to withstand investor Q&A, which comes with a lot of ease. It's not just putting it up and leaving. There's an iterative process by having 20,000 people pick apart your business plan. Those tend to do better and become more attractive to other types of investors. And that concern's not there. IPOs are generally huge events, even if they price, at a moderate range. You're still talking about 10 to 20 to 50x for the original investors or more in terms of cash on cash return. And it's, something that now there's another issue, which is that IPOs themselves have reduced it of late, discounting SPACs. There was an article in the New York Times over the weekend that public, there are 8,000, there are 2,000 fewer public companies than there were, 3 or 4 years ago. And that IPOs have been slow in coming out. There were a couple of years, a few years back that had, very few IPOs. And so I think that when the IPO market comes back and you have another way of publicly monetizing your stake, besides the stay private and the M&A takeout, then you're also going to see more opportunities. But, this sort of, if you go down crowdfunding, you're not able to raise money through Reg A or through the venture is, really not an issue anymore.
It's been amazing to see these different accelerators, these different funds, very notable, public-facing figurehead investors participate in these deals and see them grow from here. Will this be the primary approach towards capital formation if we look, 2 years, 5 years, even 10 years? I know things have taken a little longer than everyone anticipated, but if we look into the future, will this be the primary approach towards capital formation?
I do think so. I think that, crowdfunding is on a continuum, and that your initial stop will always be friends and family. You're always going to hit up your ex-colleagues or people who are in your family who want to invest and or think you have a good idea. That's always going to be kind of the first call you make. And it's actually a little odd if somebody tries crowdfunding and they haven't raised any friends and family money. So there's usually a core nexus of capital that you put in. Also, just like any investors, crowdfunding investors want to see that you have skin in the game. They want to see that you believe in the product itself and that you put your own money to work. I had a client one time that was trying to go public and the CEO had very little equity and hadn't put in as much in the business. And that was a red flag for the research analysts, for the investment bankers, for the buy side. So I think that your second stop, once you exhaust your network, is to crowdfund. And you can crowdfund at a modest amount without destroying the valuation you have for your friends and family round. But at the same time, you're really able to expand your opportunities, to expand your capital expenditures, to take the business to the next level, and to test products and to get something going, either a prototype, depending on what you're doing, or something. You get to a stage where you have this minimum viable product, and then you're able to move in all different directions. And once you have that, it's either raising more money through other channels, or you're able to go through the Reg A process and go to even more investors and raise more money there. There's talk, by the way, that Reg A could be raised from it was 50 million in the Jobs Act. They raised 75 million when they raised crowdfunding from 1 to 5. Reg A Plus has been proposed to go to 150 million, which would make it a bona fide first stop IPO. There are a lot of IPOs that are not $150 million. And so in that range, the exchanges are very interested, and you're going to see companies that are going to go public through that process. Now, the review process from the SEC is not necessarily less exhaustive than an IPO, and I've been on some Reg A reviews, which have been 4 or 5 rounds of comments. And at one point I asked, how are we getting a lighter touch than an S1 filing? And they said, well, not sure why that matters. Investors can lose as much money in your deal as they can in a public deal. So I think that you will have this, crowdfunding is going to have this permanent trial stage where companies that have hit a certain minimum threshold or have a really good idea can go out and run a great campaign. And just the process of trying to do a Reg CF coupled with being able to raise capital that way, I think will be a prominent role in capital raising as we go forward.
Agreed. I see it in a very similar way. These as, again, very impactful, very effective tools, and a very attractive way to go at this point and amplify what that first degree network's doing, even with early bird perks and share price increases. Want to ask you a few speed questions before we begin to wrap, and really around the title of the show. Like to package actionable insights for viewers, for listeners. You've seen a lot of founders do this successfully. You've seen groups not hit the amounts they were playing for, even talking about the fund and some of the deals and how those have worked out. I look at growth as a series of tests. The success of a marketing campaign, be it a Reg CF or Regulation A+ campaign, series of tests. But what should CEOs test to have a successful campaign? This does not need to be marketing. This could be around the structure, the setup of the deal. But what should they absolutely be thinking about if they're going to be launching a Reg CF or Regulation A+ deal?
Well, I think there are a couple of things you really need to be mindful of. Number one is, do I look different? Do I have a differentiating idea that is going to resonate and potentially go viral? Hate to use that expression, but where the campaign itself is going to be an easier sell. One of the things you want to think about is, what are my competitors doing? What are the competitors to my idea? And is this something where somebody's going to come in and say, well, this looks like a wrapped up version of company X, which already did that or already failed at doing that. So I think anticipate objections ahead of time so that you can explain why your product is different, or make your product different in a way that responds to the way the market has reacted to previous deals. There's an expression in investment banking: "Don't fight the tape." If the tape is telling you that they're not going to buy this type of transaction, and you see a history of these types of deals not working, then figure out why they didn't work and what you can do to improve upon that so that yours will work, or pivot in a different way. But to expect the same result, to expect a different result from putting out the same product or the same type of offering that others have put out, I think is problematic. Don't underestimate the amount of time people will look at your bios. I think people, throw together a great package. They put together a good investor presentation. They have risk factors, maybe, or they have financial statements that look good. If you're crowdfunding, you usually don't have a lot of history. And so what they're looking for more than financial results is, especially if you're pre-revenue or you need the crowdfunding to really launch your business, is what's your track record? And so people will comb through bios. They want to see that you have the experience. They want to see that you've done something that's been successful in the past. The fact that you've had X number of capital raises, or you've done an exit before, or you're part of a team that went public somewhere. Even things like your school, if it's a good school or a school you're proud of, you should be in your bio. It's something that people will take as a proxy for credibility when they have nothing else to go on. And usually when you're going out to crowdfunding, people don't know who you are, and they underestimate, or they don't know. So they look for things that are familiar to them. Oh, we went to the same school. Oh, it looks like you're an ex-Ernst & Young person. That's interesting. I know what kind of people they hire, and maybe that gives me greater credibility there. Go through your other socials too. Look at your Instagram, look at your Facebook, look at LinkedIn. If people find you on Facebook and it's pictures of you basically destroying a TV set on a Sunday because some team missed a field goal, or you have just this wild and crazy party persona on one of your socials, that's not really a great look. And so you may want to take a lot of that stuff down. You're packaging yourself as much as you're packaging the business, and you need to come across as a credible, serious person who's not going to take someone else's money and squander it or do something that demonstrates poor judgment. And so I think that it's fine to have all of your vacation photos and happy anniversary and all that. It's great, but really keep in mind that, or if you have stuff like that, turn on the filters so that they're not visible for the public. You'd be surprised how many people don't know that on Facebook you can basically turn your profile into a 2 or 3 photos just to see if we're the same person you're thinking of. Maybe one fact about you, like the town you live in, and then that's it. So I think that you need to pay attention to the optics. People are interviewing you as much as they're interviewing the business.
When I poll investors, when I speak to them, let's say in person, ask why they put funds into a deal, they reference the CEO by first name, as if they know him. Those bios really do go a long way. And I find investors do, even retail investors do like to search around, do their due diligence, look at individual social profiles, absolutely look at business profiles. I can't tell you how many issuers think they really don't need to do much on these channels, on these platforms. Maybe on the paid side with advertising, but organic. And I find many investors want to support those entrepreneurs, like you had said earlier, and see their dollar go into a more, heartwarming, more fulfilling, more enrolling goal that they want to be a part of, more than just the return. In fact, I hear the return brought up less than the cause, and being part of a company in this vertical and in this growth time. When asking Reg CF investors about it. What about optimization? What do you do when it's not working? And scaling, what have you seen the top issuers do to hit their full goals?
Well, I think one of the big things that people underestimate is the value of a mentor.
Yes.
You need to find somebody in the industry that has made campaigns work, and try and get as much free or paid advice as you can from that person. Understand what makes campaigns successful and not. If something you're doing is not working, talk to your funding portal partner. Try and find people who have done successful campaigns and ask them what made the difference in those campaigns, because the value of experience really can't be understated in this world. We're still in the early innings of crowdfunding here. A lot of people who come to these sites are new to crowdfunding, or they're new to startup investing, and they saw the ads with Kevin O'Leary or whomever, and they heard about your campaign through word of mouth, but they don't even know how to get going. The funding portal you choose is also important. It should have as little pain points for the new account sign up as possible. Some people are only on their phone, and it has to be easy to use. You can't ask me 30 questions, or I have to put it down and try and pick it up later if I remember. So the friction on which people can invest when they want to, and if you have a multimedia presentation, the ease at which people can access that is important. If you have video, try and keep the video to less than 2 or 3 minutes. It's really all you need to do is sort of introduce yourself, introduce what the company does, and what you're raising money for, and what the outcome's going to be if you raise all that you're looking for. People don't want to hear about how you rescued a dog and that led you to some idea. Here's the big problem. Here's our fix. Here's why other remedies don't work. And here's things you're probably thinking of. Have we been approved by regulators? Is this something that requires a prescription if it's in that industry? What experts maybe have said about this? If you're pushing like a neck pillow or something, here's why ours is better than the ones you buy in the airport. So I think that having a punchy presentation that gets to the point is key here, and having a way where people can go on, review your thing, invest, sign up for an account and invest in the first 10 minutes. I think that's a huge advantage over something that's a lot more cumbersome.
Well said. And it's all about putting yourself in the shoes of the target audience, the investor. So obviously that investor, that user experience in the checkout process, what they're looking for in the bios, being able to pull from competitor research, being able to really structure the presentation, that offering page, from the video length to what's discussed to how the text is articulated. Does it pass the glance test? Is there enough information for them to feel entrusting in their dollars and their investment with you? Great points. I actually get these type of recommendations, by the way, when speaking on the legal side, administrative side. You really understand how these campaigns work. Makes a lot of sense after, being part of the early stages, the early days of the space. Brian, I feel like I talked to you for hours. If anybody's tuned in right now and they want to get in touch with you, to be able to speak to Manatt, or even just find some more information online, where are the best places for them to go to learn more? And any final statements, final thoughts you want to leave us with here today?
No, I was going to tell you a funny story about the Knicks.
Please.
We were closing the deal. Starwood's going to buy ITT, and the leagues had not yet finalized their approval, which was required for the purchase of the teams to go forward. And I was an associate, and the partner said, well, call the league and find out what the story is. And this person from the league, from a big law firm partner, said, league is not consenting to the following terms, and gave me like a list of 6 things that had to be fixed. And I went into the partner's office and I said, here's what they think they need to get approval. And the guy's like, that's not going to happen before tomorrow. Tell them it'll be a post-closing item. And I called the person back from the league, and they said that if we close the deal, the membership of the Knicks in the NBA will be suspended because their ownership will be in violation of, league policy, X point, whatever. And I said, okay, well, are you going to tell the people tonight that the game is not happening? And there was like a long pause on the phone, and he said, have a good day. And he hung up. So, you can only bluff as much as you can really bluff, because there was no way that the game that night was going to be canceled because of a change of ownership of 10% of the ownership team. But so I guess the moral of that story is, kind of be careful making demands if it's something you really have no way to fall back on. But if you want to get in touch with me, it's Brian Korn, BKORN, at Manatt.com, MANATT.com. You can also call me at 212-790-4510. All of our information's on our website, Manatt.com. If you search for me, you can also see a list of publications we put out. We put out client alerts on a very regular basis in this area, probably one a month. We put out one last week about what to do during the shutdown, now that it's gone on for a record 35 days. Please be in touch. I'm on LinkedIn as well. And I will get right back to you. Happy to talk to you about my experiences, my advice, off the clock. And if there's a match, then we can go forward, or I can refer you to other people in the field who fit your needs.
And highly encourage listeners, viewers, to take Brian up on that invitation. Brian, you're a wealth of information. I've taken 2 pages of notes, and I work in the same space. I really enjoyed the background stories as well too. That's funny that that's where they're going to draw the line with the Knicks and having to tell the fans. Oh, okay.
Yeah. Well, the other fun story I had was we were in Enron, and we had to sell a power plant in Brazil, and the Brazilian government said the list of buyers for this plant is the government-owned agency, and that's it. And so we called their counsel at Sherman and Sterling, and they said, well, I guess you're selling to us, so there's nothing to negotiate. So, but
That's
anyway,
how
it's
it's
great
done.
to have
Yeah.
you. Great to join you, and great to talk about this really interesting topic.
Absolutely. Brian, pleasure was all mine. Thanks for taking the time to hop on the podcast. And everybody tuned in, appreciate it. Get in touch with Brian, and we'll see you next time. Thanks, everyone. Take care.